An investor told me Africa was too risky. I had 5 minutes to respond. Every time I pitch an LP on Africa, I hear some version of the same thing. Sometimes it is direct, Africa is too risky, and sometimes it is more polished. We're waiting to see more exits. Sometimes it is just silence after that pitch, which tells you the same thing. I have been hearing this for 4 years and I want to address it today. Not defensively, not as someone who is trying to sell you on something, but as someone who has looked at the actual data and watched the narrative refuse to update against it. Before I get into the data, I want to tell you something. An early stage African VC firm put $150,000 into a company at early stage. When that company reached unicorn status, they exited part of that position for approximately $8 million. That is a 50x return on a single check. In Too Risky Africa, I'm going to show you exactly how that happened, why it matters, and why the investors were still using the risk narrative as a reason not to be in this market are making a specific, identifiable, correctable error. The distinction I want to establish today: Africa is not too risky. Africa is too overlooked. And those are not the same thing. Section 1, where the risk narrative comes from. The Africa risk narrative is built on a few real facts, stretch far beyond what those facts actually support. African startups have higher failure rates than startups in more matured markets. Currency volatility is real. Nigerian naira lost roughly about 40% of its value against the dollar in 2024 alone. After the liberalization of the currency ban, the regulatory environment is fragmented across 54 countries, each with its own requirements, infrastructural constraints, power, logistics, digital connectivity. All of these create execution challenges that do not exist in the same way in San Francisco or in London. I'm not dismissing those facts. Every one of them is real and every one of them shapes how I evaluate companies. But I want to ask you something directly, and I want you to answer it honestly to yourself, not for me. If you are an investor who has not done deep research on Africa, how would you describe the risk? You probably would say something along the line of political instability, currency volatility, unclear exits, regulatory unpredictability. That answer sounds like analysis, but here's what it actually is: a description of things you have heard, dressed up as a conclusion you have drawn. Unfamiliarity getting dressed up in a language of risk. That is what I am asking you to examine today. The question is never, is there risk? The question is, does the return potential justify the risk? And have the risk been accurately assessed? When I say Africa is too overlooked, I mean that the risk has been dramatically overestimated relative to the return potential. And the perception has been shaped more by distance and unfamiliarity than by actual data. Section 2. What the data actually shows. Let me give you the data. African startup funding peak in 2021 at close to $6 billion. It contracted sharply between 2022 and 2024. VC deals fell approximately 52%, more than any other region. African startup raised approximately $2.2 billion in 2024, and 2025 shows strong recovery with approximately $3.2 billion, the strongest year since 2021 peak. In 2024, fintech was the dominant sector by both volume and capital raise. 116 deals raising roughly $1.4 billion, representing 59% of total African VC funding. Despite a 20% global fintech funding decline, 10 African fintechs were ranked in the global top 300 in 2025. That is not a struggling ecosystem. That is an ecosystem finding its footing after a global correction. Let me talk about exits, because show me the exit is the LP objection I hear most often. I want to give you the numbers that should end that conversation. We Capital, an African VC firm, invested about $150,000 in MoneyPoint. When MoneyPoint reached unicorn status, We Capital partially exited that position for approximately $8 million, 50 times the investment in Africa from $150,000 check, at a time when most global investors were not paying attention. Paystack, founded in 2015, raised just over 12 million in total funding, acquired by Stripe in 2020 for a little bit over 200 million. That is a 16x plus return on capital raised at exit. It was also the moment that proved to a global audience that African tech companies could actually produce landmark outcomes. InstaDeep raised over 108 million and was acquired by BioNTech in 2023 for approximately 550 million in cash and in stock. African founders building at the intersection of deep tech and pharmaceutical applications. MoneyPoint started as Team App, pivoted to business banking to Nigeria's small and medium enterprises, raised a 200 million Series C with banking from Google's Africa Investment Fund, Visa, and IFC, and reached a $1 billion unicorn valuation and is profitable while processing over 800 million transactions per month. Between 2023 and 2025, Africa recorded over 100 startup exits, including more than 50 M&A deals in 2025 alone, the highest annual M&A figure in 5 years. The exits are real. The founders are exceptional. The thesis is proving out. Part 3. The actual risk landscape. I want you to be honest with you about where the real risks are, because I think dismissing risk entirely is as irresponsible as overstating it. And part of why people do not trust the African investment narrative is that they have heard too many people who will not acknowledge any risk at all. I am not that. Currency risk is real. Again, like I mentioned before, Nigeria's Naira devaluation in 2024 hurt companies that were earning in Naira and had dollar-denominated costs. Companies that understood this and structured accordingly, that earn in multiple currencies, that had dollar revenue from cross-border customers, were significantly more resilient than those that did not. This is not a reason to avoid the market. It is a reason to understand it before you enter. The market concentration problem is also real. Nigeria, Egypt, Kenya, and South Africa captured a little bit over 88% of all African tech startup funding in 2024, and I believe similar in 2025. That concentration means opportunity. That opportunity in undercapitalized markets like Francophone West Africa, East Africa outside of Kenya, and Southern Africa outside of South Africa. But it also means liquidity for exit is the most readily available in those big four markets. Execution complexity is also real. Building in Lagos is not the same as building in Nairobi, which is not the same as building in Accra or in Yaoundé, Cameroon. African countries are more different from each other than they are similar. Any investors who treat Africa as a monolithic market is going to make systematic errors. The early stage funding gap is also a risk, but it is a risk that creates opportunities. Active pre-seed investors in the African ecosystem dropped from approximately 200 in 2022 to approximately 135 in 2025. Fewer investors competing for the same deal flow at the same stage with the highest upside. That is not risk I'm trying to avoid. That's actually the opportunity. I invest here knowing all of that. I invest here because when I look at the risk return profile, honestly, the return potential justifies the risk by a margin that most other asset classes cannot match at this stage. Section 4. Why overlooked is the correct diagnosis. The Africa risk narrative is self-reinforced in a specific way because international capital has avoided the market. The ecosystem lacks the infrastructure that makes future capital more comfortable entering. Fewer exit means less data. Less data means more caution. More caution means fewer investors. Fewer investors mean fewer exits. And at every point in that cycle, the investors who are not in the market says, see, the market is not ready. But the market does not get ready on its own. It gets ready because someone showed up before the infrastructure caught up, built the track record, and gave the next wave of investors something to follow. The discount is real. It closes as the narrative catches up to the reality. The investors who are not in Africa are not avoiding it because they did the analysis and decided that the risk return profile was unattractive. Most of them are avoiding it because Africa is unfamiliar territory, and unfamiliar territory gets dressed up in the language of risk. The projected digital economy for Africa by 2030 is 1.5 trillion. The continent has 1.4 billion people, with 75% under the age of 35. The business model that is going to serve that population has to be built on the ground by the people who understand the market, with the capital that has been committed for the long term. For diaspora investors specifically, the asset class conversation is important. The illiquidity of a VC fund, the 10-year horizon, the complexity of underlying companies, these are real barriers to entry for a first-time LP in an African fund. That education gap is part of what this channel is here to close. The investors who put money in African real estate in 2005 look different from the investors who put money into African tech in 2025. In exactly the way that the investors who put money in Southeast Asian tech in 2010 look different from the ones who waited. The timing window on this is not infinite. In 2024, local investors became the single largest LP group in African VC for the first time, accounting for 31% of total commitments. The continent is increasingly investing in itself. The question for diaspora and international investors is whether they are going to be part of that shift or observe it from the outside. If you are an investor, institutional, individual, or diaspora, I want you to do one thing this week. Go look up the actual return in the early stage pay stack investment. Go look at what we capital return on 150,000. Then ask yourself, is the narrative I am operating on consistent with the data I am now looking at? Drop in the comments. What is your honest objection to Africa as an investment thesis right now? I want to hear the real ones, not the polished version, because the polished version is what ends conversation. The real one is what I can actually address. Subscribe for the next episode where I break down the sectors beyond fintech that are going to define the next decade of African tech.